Good morning. It's Friday, the 25th of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's warm financial capital. The take. Sunil Nanda, a BITS Pilani graduate, founded the India Design Center of Nvidia Graphics in Bangalore in 2004. That's what it was called then. Just 11 years after the company itself was founded in 1993 in the United States on the West Coast. A job description I found from that period for Bangalore said Nvidia was looking for talented people who are passionate about the visual computing industry. We want individuals who are highly motivated and strive for perfection in their work. If you want to be part of a company that is shaping every pixel on millions of screens across the world, come join us, the advertisement said. While Nvidia's Design and Engineering Center came up in India about 20 years ago, it actually came after chip giant Intel, who had already set up in Bangalore roughly 6 or 7 years before that. And Intel was the big brand and draw, including for journalists like me who were chased visiting Intel brass for interviews. Nvidia was there, but except for the tech and gaming media, no one really cared that much. After all, it was just a gaming chip. Intel's largest engineering site outside the United States, even today, is in India and has over 13,000 employees, of which about 90% are engineers. Nvidia is large in India too, but smaller in absolute numbers, being a smaller organization as well. Nvidia founder Jensen Huang is presently visiting India and is being given the rockstar treatment as he's feted across events and appearances, as he is elsewhere in the world when he visits nowadays. Thousands turned up to see him and thus delayed an event featuring him in Mumbai on Thursday. Until quite literally a few years ago, Jensen Huang's visits to India would have largely been unnoticed, except again by tech media perhaps. A $3.4 trillion market capitalization number in breathing distance of Apple obviously has changed many things. It's also a reminder of how rapidly things change in the technology world. Intel, the ruler in the chip space for decades, has lost its preeminent leadership position thanks to a shift to high-performance artificial intelligence or AI chips of the like that Nvidia now dominates. Reports in August even suggested that Intel would lay off some 15,000 people, even as talks of Intel being acquired constantly surface, an unthinkable proposition a year ago. India has a role in these companies' global rise as well. Intel and Nvidia arrived in Bangalore more than 2 decades ago because they saw potential in India's engineers as much as the market in which they both sell their products. On both counts, India has served the global technology industry well. But tomorrow's winners will typically arrive quietly today, and if only they see raw potential as these companies did once. When Nvidia's first key hire, Nanda started off with a little over 100 colleagues. Nvidia was looking for people passionate about, like I said, the visual computing industry. But today it's a force in artificial intelligence, reflecting how the company itself has pivoted over the years. We know from experience that India is home to some of the world's brightest engineers, as many of our top employees today are originally from there. India is strategic to Nvidia, and we're delighted to become a member of the Bangalore community. Jensen Huang had said this in 2005, but he could well be making that statement today. That is a reminder of India's strengths and in some ways the challenges ahead if it has to stay relevant in the global technology race. And that brings us to the top stories of the day. The stock markets are flat once again, but could they stay here? The surprising story behind the record $10 billion of stock sold by FIIs in October. Manufacturing PMI picks up. Indian companies are not doing enough on data privacy awareness. And the government approves a 1,000 crore fund for space startups.
This is the Core Report with Govindraj Ethiraj.
Markets are steady to flat. Market watchers heaved collective sighs of relief, I'm guessing, after the market's fall seemed to slow down on Thursday. The BSE Sensex and NSE Nifty ended Thursday's trading session somewhat flat, though down. The Sensex was down about 17 points to 80,065, and the NSE Nifty 50 was down 36 points to 24,399. The Nifty Mid-Cap 100 and the Nifty Small-Cap 100 were down by about 0.25% each. So the domestic cues are still somewhat negative, though the global cues are somewhat positive to mixed. Oil prices are edging higher and tensions in the Middle East continue, but corporate performance in the United States is strong. On Thursday, the S&P 500 was up after 3 straight losing sessions. A surprise was Tesla, whose stronger than expected earnings pushed up markets. Tesla surged more than 14% after it posted third quarter results that beat analyst expectations, CNBC reported. Adding that more than 32% of the S&P 500 companies have now reported third quarter numbers in the United States. Of those companies, 76% have beaten analyst expectations according to FactSet. I don't have the Indian number for this or the equivalent for this, but it is evident that results here are trailing expectations in the latest quarter. But then the United States is on a very, very strong economic growth path. Oil prices are rising once again. Oil prices rose on Thursday, reversing some of the previous session's losses as the Middle East conflict and reports of North Korean troops ready to help Russia in Ukraine kept traders on edge, according to Reuters. Brent crude futures were up about $1.26 to about $76.22 a barrel, so above $76 on Thursday. Oil prices have now gained about 4% this week after falling more than 7% last week on concerns of oversupply and weak demand and a perceived calming of Middle East tensions, which of course has not happened. An analyst at oil broker PVM told Reuters that the opposing forces of economic anxiety, loose oil balance, and potential war-related disruptions, supply disruptions that is, will ensure that no clear oil price direction emerges in the immediate future, while the risk remains skewed to the downside in the medium term. Foreign portfolio or foreign institutional investor selling the untold story. Heavy selling by foreign institutional investors, more than $10 billion, has caused the markets to fall and weaken the rupee, taking it to a record low, among other things. So why are foreign institutional investors selling so heavily in India? Well, the reasons are somewhat known and are mostly to do with them moving funds to China to ride on the post-stimulus upside there. Also, broadly, valuations in China are lower and in India they are higher. But what were they selling? So the intuitive answer to that would be that this was everything they owned. Not true, says an insightful study by Vinod Karki at ICICI Securities. According to him, most of the selling has happened in what he calls consumer-centric stocks, contributing to more than 66% of the mix. More specifically, the selling has included financials, likely led by retail consumer finance-focused lenders, and manufacturers of consumer products, which include consumer products, that's FMCG, auto, and other discretionary expenditure. Some 19% of the selling was linked to energy, but that's in turn linked to Reliance Industries, which in turn is linked to a heavy play in retail and telecom. So Reliance is now also a consumption and a consumer play, and not so much, or rather not only the energy play that we knew it as. Meanwhile, there was moderated selling in areas like IT and healthcare, or what is known as defensive sectors, while there was a mixed bag amongst the industrials with moderate selling and buying in chemicals and metals. So the interesting factoid here is that despite all this selling, FII holding in Indian equities as of the first half of October is actually still around 16.3%, which is higher than the 16.1% in July. So there's clearly a lot of funds that's coming and going and maybe coming back. So if FIIs are selling more sector specifically rather than the whole market, this also suggests that there is in some ways maybe a bigger problem than the rather general problem that we thought there was, at least through the FII institutional investing lens. So I reached out to Vinod Karki, equity strategist with ICICI Securities, and I began by asking him what he was taking away and his outlook on the overall equities space right now.
The trigger was the China big rally in China, from where we start seeing this and big outflows in India. Coming to where the selling is, we tried to triangulate the trend by looking at several factors. So one is basically the fortnightly data, which tells us which sectors buying and selling has happened in from FI side. What it is telling us that biggest selling is happening in financials. Now, when I triangulate it with the stocks where these guys have the largest holdings and the stock reaction, it tells us that consumer lending, unsecured lending kind of stocks like, some of these NBFCs and even the large banks which are retail oriented, they seems to have fallen during this period. So obviously, it must have been selling in this area. So it's consumer lending centric stocks, then followed by the consumer product companies themselves. I mean, FMCG, auto, consumer discretionary. These are sectors where this maximum selling has happened. And in between, there's energy. Within energy, one of the largest holdings is basically Reliance, which is a large conglomerate, but the rising share of consumption. It's no longer just oil and gas play. So I think contrary to a typical risk-off environment selling by FIIs, which typically is in cyclicals, it seems to be more pronounced toward consumption-led lenders as well as products companies, basically. Whereas the rest of the industrials, if you see, it's a mixed bag, moderate selling in some sectors, some buying, other defensive like IT and healthcare also seeing some moderate selling. That's how this has panned out.
So that's interesting. So why do you think this is happening? And specifically, why NBFCs or FMCG and so on? And why now?
Yeah, I think some of these stocks, we have put out that list, which have been kind of the favorites for the FIIs in general in India. From the large holding perspective, it was these large banks and NBFCs which used to do a lot of retail credit. That seemed to be the case. But what has happened over the last 5 years post-COVID rally, the rally has largely been the capex-driven sectors, the capital-intensive sectors, the corporate lenders, PSUs, defense, manufacturing. And these sectors have never been their favorites the last cycle. I think that is a rebalancing, recalibration that's happening, that the supposedly is very safe liquid names in consumer finance and consumption, where they are disproportionately high level of holding, is getting transformed into, I mean, they're even buying small and mid cap despite all their riskiness. So which is the kind of, I think it's more of a recalibration than a signal of a risk of selling in India. That's what how I read it. Correct.
Right. Okay. So if I were to ask you to, dive into that a little more, so how would this relate with, let's say, the kind of Q2 performance we're seeing, particularly in consumer products and consumer facing industries?
No, in fact, it is actually not on the portfolio recalibration. The whole economy is moving in such a way that we are having the performance of retail credit as such. If you see the credit growth numbers, the retail credit has been unsecured lending, both from the regulator's perspective and the stress in the economy is decelerating, while industry credit seems to be picking up from single digit to 10% now. And especially in the mid and small companies, it's in the teens, the growth in industry credit growth. So I think the economy itself is giving you a sense that the investment side of the economy is outperforming the consumption. And consumption has another big issue, which we are seeing over the last year or so. If you look at the agri GVA, it is agri GDP rather, it's just barely growing, 1% growth versus the aggregate GDP is growing at around 7% plus. So when you do the agri versus non-agri GDP, it's very clear that the agri GDP is 1% odd on a trailing 12-month basis, while rest of the economy, ex-agri economy, is growing at around 8%. And the latest numbers for rural CPI, not just this overall CPI, but rural CPI indicates that number is close to 6%, while the income growth is trending lower to around 5 to 6%. So on a real income basis, rural India is getting into stress, I guess. And there are some indications that you'll have a severe winter, and there have been extended rains in October, where it's the Kharif harvest season. So I think some of these things are creating problem on the income, productivity, and real income for the large rural consumption package. So I think it's getting reflected in stock reactions. You can see it today also, results muted and things like that.
And you're also saying that after all of this, the proportionate foreign portfolio investor holding in Indian equities has actually gone up to 16.3%.
It did go up. I mean, it bottomed out at around 16.1% around July. It went up in August, September till about 16.3. It is slightly higher than it. So the point we are seeing is that over the last 6 months, this number of FPI holding of Indian equities seems to be, just jumping around the bottom. There have been patches of selling and then buying and then selling and that kind of a thing. So currently it hasn't broken down below that 16% range, which hit already in July.
You've also touched upon domestic institutional investors. So as you see things today and maybe in the next quarter or so, how do you see the investing strategy between domestic institutional investors and foreign institutional investors? So foreign, you've already talked about. What's the sort of convergence or divergence with domestic?
One thing that's come out very clearly is that while the FIIs have been selling these large retail banks and all, it seems that that's being absorbed by the domestic guys because the valuations are no longer quite demanding. I mean, that's the only space I would say in the whole market where valuations are cheaper than they were before COVID hit us. I mean, that's the only sector apart from commodities, basically. Financials and commodities are the only two sectors in the market right now which are relatively less expensive than they were pre-COVID. All other sectors are way above, basically. So I think domestic guys in general are buying across sectors, but more of a, that the supply when it comes from, whatever large supply comes from FIs, they tend to absorb that if valuations are not quite expensive, like it's happening in financials.
Right. Thank you so much for joining me.
Thanks, Owen.
Business activity picks up. Growth in India's business activity picked up slightly in October after slowing down last month thanks to a stronger demand in manufacturing, according to a HSBC survey that showed job creation also rose at the fastest pace since February 2006. HSBC's Flash India Composite Purchasing Managers Index, or PMI as it's popularly known, which is compiled by S&P Global, rose to about 58.6% this month from September's final reading of 58.3, which was a 10-month low. So the readings do keep shifting between the intermediate and the final. But the headline index has been above the 50 level, separating growth from contraction for about 39 months, the longest expansionary streak since June 2013. HSBC said that India's flash manufacturing PMI indicated that the manufacturing industry regained growth momentum in October. Several components accelerated after a modest slowdown over the past 2 to 3 months. And of course, it would be interesting to see how the next couple of months do, given the fact that we are now looking at weakened corporate performance. Germany and India in agriculture. Now, this is interesting because the figures shared and the contrast they represent are useful to revisit, though there is nothing dramatically new in it. Agriculture is the most problematic area in talks to secure a free trade deal between India and the European Union, Reuters reported German economy minister visiting India, Robert Habeck, saying on Thursday, suggesting that it would be better to focus on the industrial sector first. Habeck, who's in India, said that agriculture is a problematic area as there is a huge variation in the number of people working in the farm sector in India and Germany. He told reporters, adding that it was 2% of the population in Germany compared to 60% in India. So he said that you cannot compare the two agricultural systems, and if you were to open the markets completely, the disruption to the Indian market will be tremendous. And instead, it would be faster, smoother, and practical to focus on the industrial sector. India and the EU agreed in 2022 to relaunch talks on a free trade agreement, initially aiming to complete talks by the end of 2023. But obviously, there has not been any significant progress, with India blaming irrational standards set by the EU as one of the reasons, according to Reuters. Why companies have to invest more in awareness on data privacy. Last year saw the introduction of the Digital Personal Data Protection Act, DPDP, legislation which broadly aims to empower individuals like you and me, or data principals, as we could be called, by strengthening our rights to control personal data while simultaneously enhancing accountability for businesses and institutions who handle our data. The US and EU have rolled out similar legislations earlier. So while this is an important piece of legislation in this digital age, awareness of it is low. Moreover, companies are not doing enough to ensure that their own consumers are more aware. Given that our behavior and interactions, including for commerce, are increasingly technology and data-driven, understanding of and embracing the tenets of privacy becomes critical. So the findings that I referred to earlier are the outcome of a study run by consulting firm PwC to gauge where India stands in relation to privacy literacy and the obstacles that lie in the way of building a culture of privacy, first in the country, and how these gaps can be bridged. PwC connected with some 3,000 consumers across the country from different regions, age groups, and educational profiles, and also with about 200 companies. So it found the gap, as I just said, in the understanding of the basic tenets of privacy amongst all, and not so much desire on the part of companies to invest in consumer rights education. So think of a bank with whom you have a continuous relationship and ask whether you feel they inform you adequately on your privacy issues. So PwC says that from a consumer standpoint, the lack of awareness about certain privacy-related processes, protocols, rights, or responsibilities may not come as a surprise. There is an overall lack of trust in business. I spoke with Heena Vazirani, partner at PwC, who focuses on risk consulting, and I asked her why companies were not putting enough effort here.
The first aspect is, what is data privacy? Frankly, data privacy is a fundamental right that was passed in our constitution in 2017. And the fact that, culture as a culture, we usually in India just freely give away our personally identifiable information or personal information, whoever is asking without any, questions. It was important that there is a regulation also that controls it. So in August 2017, the government published a particular act that's called the DPDP Act. What it is doing is it is telling organizations who are dealing with personal information to build security related controls, ensure that the data is securely maintained, and there are certain rights that have been given to individuals like us to ensure that we are able to have that fundamental right over privacy as well.
So, one of the findings of your survey is that one is, of course, that people are not conscious enough, but equally, companies are not investing enough in building that consciousness. So, I think there are two parts to this question. One is, to what extent are the companies responsible for doing so? And secondly, why are they not doing so?
Business as usual is going on. There are very limited options that people have. If you see that when I want to engage with a particular organization on a digital platform, there will be only X number of organizations who are giving that option. Frankly, business is going on and people do not have an option, so they will continue to do so, and they will continue to give their personal details if they're asked so that we can get that service. Organizations are not really focusing on this aspect because, again, the business continues. But having DPDP into place, it's a business opportunity as well, because companies can go back to their consumers, take it as a opportunistic aspect and say that, look, now we've implemented certain controls that are expected. We've implemented security related aspects. We are covering all the aspects of data privacy, data breaches. We are giving you all the rights. You will see that companies who give that trust back to the consumers, there will be rise in the number of consumers. And with the limited choice also, there will be a preference that will be given. And that eventually will raise the number of consumers for a particular platform if that trust is shown, the trust and transparency.
In your survey, did you find certain types of companies who were, let's say, one is complying or leading the way in setting good standards, and some types of companies who are not?
Going one aspect that we have to remember is that there are only certain sectors who have been regulated in nature, right? BFSI being the topmost. To a certain extent, there are a lot of regulations that are prevalent in the pharma sector also. And other sectors do not have so many, governing bodies or laws that are embedded around personal information per se. So in our survey, we observed and got a similar outcome to say that companies who are way ahead in terms of implementation are at a broad level BFSI firms as well as pharma companies, because of the nature of the operations and the governance around, other regulatory authorities on those sectors. Other companies are, I would say, comparatively going towards that journey now. And it's because of the mandate of compliance. And they are approaching and looking at this aspect because now this will become a law. And obviously, there are certain financial implications that are linked to it. So they have to eventually do it and implement those aspects.
Right. So, as you look ahead, what else do you feel needs to be done to ensure that this act that was passed last year, it's truly implemented? For example, let me give you a context. For example, we hear a lot about internet scams nowadays, phishing or even direct WhatsApp messages, people getting phone calls. So there is a culture, there is an ecosystem where clearly people are falling prey to things, which is linked to the fact that they are either not guarded enough or could be better guarded. So what's the broader challenge or way forward in your understanding?
So, Govind, what I look at when I look at this act, for me, and frankly, I've been in the space of privacy since 2013. So I've been doing this work, this sort of work, for almost a decade now. A lot of times we go back and say that an organization alone is responsible for it. But at the same time, when we look at the other regulations globally, it is also the individual who has all the rights to question organization and ask them that, what are you doing about my data? Or the question to say that, do you really need so much of information? Can it be done with only limited information? So the consciousness of an individual to not give out information so easily or give it only for the purpose that is required is a big change that would also help us reduce these kind of frauds. Today I go to a restaurant and the restaurant will, give me a form to fill and say that give your feedback. And then they will have all those freebies listed down. Because you're a privileged customer, can you give me your birth date? Can you give me your anniversary? Give me your spouse's name? Give me your, all the details will be asked under the pretext of saying that we will give you freebies. And Indian mindset, I would not say everyone 100% is like that, but a lot of them will say that, okay, I'm getting a freebie, why not give the information? Now, someone who's tech savvy, you swipe your credit card there, and you step out of the restaurant, someone who's tech savvy can easily go change the code, use these details. You remember, if you looked at certain platforms, they will ask you, what is your wife's name? What is your anniversary? What is all of those questions are very easily to guess sometimes when you give out this information. So obviously you will fall prey to a lot of digital related frauds. Now, what is important for DPDB to be a success, or privacy as a culture in the whole ecosystem to be a success, is one, when the information is being given out, definitely organization has to take care of the controls, security related aspects, prevent breaches to happen, keep the users aware, ensure the rights are given. That is understood and now, well spoken about. The second aspect is also upon us as individuals, as our duties to say that, am I giving information which is really not needed? Is it that I am giving someone else's information to safeguard myself? Or a lot happens here, right? I would not want someone to call me continuously, so I would give someone else's number, my friend's number, my husband's number, my cousin's number, just to say that, okay, call this person and don't call me, right? So I think that consciousness is really needed now for it to be successful, because both are an equal part of this ecosystem.
Right, Heena. Thank you so much for joining me.
Thank you so much, Govind. It was a pleasure. Thanks for inviting me.
And funds for space. The government on Thursday approved a 1,000 crore fund, roughly $120 million, for the space sector, with 40 startups expected to benefit as the country aims to win a significant share of the commercial space market by 2033, Reuters reported. The funds could range from about 100 million to 600 million rupees. That's 10 crore to 60 crore rupees, depending on how mature each startup is. And the funds will help generate employment, boost technology, space technology developments, fortify supply chains, and R&D, the government said. The fund was first proposed in July, and around the budget will be managed by the country's space regulator, which is the Indian National Space Promotion and Authorization Center. India is amongst the top 5 spacefaring nations in the world, but only holds about a 2% market share of the commercial space market. But India has nearly 250 space startups, many of whom are in the business of providing cost-effective services and hardware to sectors such as communications, agriculture, and commodities, where high-quality data is a precious resource, Reuters reported. And before we go this Friday, some feedback, which we always welcome. Clay Madness says, finally an actual daily news podcast on the stuff that matters and delivered in a sedate and engaging manner. You've earned yourself a new follower. Tarun Kumar Singhal says, very concise and precise and comprehensive without any signs of verbosity. Zed Marolia says, hey Govind, pleasure listening to you every morning. Thanks. On the healthcare issue, I would like to suggest another angle to be probed. If it is the threshold levels of readings in medical reports and the narrowing and in some cases redefining of levels at which a person is labeled a diabetic, pre-diabetic or hypertensive, there is no doubt about the increase in lifestyle diseases, but maybe there are more than one force at play. And I totally agree with that, because this is something that I've been hearing too. Just a thought, says Marolia, maybe worth a dig, and you can have some senior general practitioner doctor on the show, as they have some pretty strong views on this. And once again, the core report is an excellent way to start the day. Thank you all for your very wonderful feedback, and I do hope to incorporate this. And thank you, Marolia, specifically for that healthcare linked input. I will follow up on that. Have a great day. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.